As the portfolio manager of the Platinum Japan Fund, can you tell us a little bit about the history of Platinum, your background and your investment team?
So Platinum was founded in 1994 by a core group of investment professionals, most of who are still with Platinum. I joined in 2001. Care gave me an opportunity to transition from engineering, which is my core technical knowledge, to investment management. In the early days, in the first years, I was looking at resources companies, a broad range, whether it's copper, iron ore, all the way through agriculture, the broad resource and industrials complex, some global capital goods companies like Caterpillar, Komatsu, John Deere. So I developed and honed my knowledge in all those areas over a long period. And about a year ago, I was given the opportunity to manage the Platinum Japan Fund. That knowledge that I had prior, that I had developed over that long period, is very useful in Japan, given their strong industrial manufacturing base, their exporters. So in the last 14 months, I've obviously taken that knowledge that I had and all the other background that I'd developed in that period since 2001, working with Care, and applied that to the Japan Fund. So obviously the Japan Fund has a wider range of investments, but that core knowledge that I developed in the earlier years has been very, very helpful.
How do you manage the Japan Fund from Sydney?
We have 2 native Japanese speakers who can assist us with cutting through the language barrier. Most of the companies we invest in have English-speaking CEOs or CFOs, which helps us get the information we require. But the key is for us to be skeptical and to look through the massive information we're giving and discern what's really important and to find the arbitrage. We travel to Japan quite often, every 3 months perhaps. Last few visits we visited 150 odd companies across a broad range of industries.
Your strategy focuses on absolute returns. Can you describe your net equity invested exposure ranges and how and why they change?
Markets are volatile, so we do like to have a cash allocation, a cash holding, to provide us the potential to invest when you find the right opportunities. So it's quite rare that we will be fully invested in the fund. At the moment, for example, it's hard to find opportunities, so the cash levels are building, and that's what you'll find is a typical invested percentage between 70 and 90%. As valuations get higher and opportunities become fewer, the cash levels will rise and vice versa.
Yep. Can you talk through the investment philosophy behind your investment strategy?
The core of the process is finding stocks where you can see medium to long-term value that is underappreciated by the market. So it's a company by company specific, trying to find the arbitrage, trying to find the opportunity for the multi-year investment. So one example at the moment is one of the companies we're looking at has, we think, discovered the cure for cirrhosis, for liver cirrhosis. So if that's the case, then the company is very undervalued, and then that can apply to other parts of the body as well. So the upside opportunity is many-fold relative to the current valuation. So from the core stock picking basis, you then have to provide a macro overlay. In Japan, given the levels of debt, given the other its place in Asia, so it's next door to China, has Korea as a competitor, you have to consider the external environment. That is partly the currency, it's also partly the trade flows, it's the price of debt, etc. So in that core specific company analysis, you then have to consider the wider spectrum of influences on that company.
You manage a concentrated portfolio of around 40 to 80 companies. Can you explain the stock selection process behind the portfolio?
Yeah. So there's a few types of screens that we run. One is a quantitative screen where our quantitative analysts work through their database and find a group of companies which meet a set criteria. And we go through that regularly and then apply other screens, qualitative screens on top of that. The other one is that we've been investing in that market for almost 2 decades. We know the companies, so we're continually just cycling through, whether it's the Toyota Group or Mitsubishi Heavy, a wide range of companies that we have a long experience with, continually going back. Fanuc, for example, reassessing their opportunities. Fanuc makes the aluminium body for the iPhone, assessing the product cycles that Apple's going through. So it's a continual refresh of all the investments that we've owned in the past, check the valuation, get a company update. And so it's those two different types of screens, the quantitative and then our history that we continually cycle through. And it's a continual iteration of those two groups of companies.
Being a Japanese equity strategy, can you explain what sort of industries make up the Japanese portfolio?
The Japan Fund will always have a diversified portfolio, a mix of financials, consumer, hard engineering, service-oriented companies. Japan is a developed nation. It's got a large export sector, but there's a wide range of opportunities across all the sectors you would recognise in the developed world. So our portfolio is always going to have a mix. Obviously that mix will vary depending on valuations and the opportunities, but in summary, it's a diversified portfolio both by the type of company, the opportunities that those companies have and the valuations.
Your fund has an absolute return focus. Can you explain why you use short selling and how that reduces market exposure?
The core focus of the fund is to find medium to long-term value opportunities. At times, valuations in the market get a little wild, a bit speculative. Our first preference in those times is to have a cash holding to protect the capital value of the fund. In certain cases where valuations get too speculative, we will put on index shorts and at times stock-specific shorts.
Your strategy can have an allocation to Japan and Korea. Can you explain how you manage the currency within the portfolio?
The management of currency is very important for Japan and Korea given the volatility and the export-based natures of those economies. As the currency strengthens or weakens, the equity markets respond. We can't fully shelter investors from that volatility. By its nature, investing in Japan and Korea gives you currency exposure. At times, when the currencies become or move too far in either direction, we will take a position in those currencies, but our preference is to have a natural exposure, an unhedged currency position in Japan and Korea.
When is the portfolio likely to perform? And in your experience, when do you see periods of underperformance?
Because of the risk management strategy of the fund, it's likely that in periods when the market has gone up a lot and valuations are expensive, the fund is more than likely to underperform. However, when valuations become cheaper and there are lots of opportunities, you would expect us, because of our contrarian nature of our investment strategy, to outperform in the subsequent period.
Japan is a region renowned globally for its industries. Yet recently we've seen sectors such as technology being superseded and overtaken globally. Why should an investor invest in Japan?
It's clear that Japan has faced an enormous number of competitive threats. Korean manufacturers of large ships, LNG ships, LNG carriers, etc. And now China. China with their low-cost manufacturing, their wonderful infrastructure. Japan is suffering from this extraordinary competitive threat. And you can see that in Japanese GDP. Underlying Japanese GDP is falling, but that's been offset by tourists into the country. They've lost their advantage in LCDs in so many industries. Having said that, you can still find companies where Japan is a regional and global leader. So Toyota still is the premier car company with their Prius and their next generation automobiles. You look throughout the region, they've got some great positions in Thailand, Indonesia, Burma, even in India, Maruti Suzuki. Japan has both a regional and a global focus, as well as domestic sectors. So there's a lot of domestic sectors where you're having large growth stories, 20 or 30% compound as the new generation of companies overtake the slow-moving incumbents. So like any developed market, there's a wide range of opportunities, not necessarily the opportunities of the past, but new ones that have come along.
What's the recommended time frame for an investor?
given the nature of our process and our search for undervalued and unloved companies, which often we find the thesis takes a while to play out for the positive developments that come through, the recommended investment time frame for an investor is 5+ years.